Welcome everyone. My name is Philip Beethoven-Wilson with the Legacy Advisor Group. Thank you for joining us today. We're diving into the One Big Beautiful Bill Act signed into law this past July. It is a sweeping update that makes many of the 2017 Tax Cuts and Jobs Act provisions permanent and introduces new temporary deductions that could significantly impact your 2025 to 2028 planning. I'm joined by Karen Redding, one of our advisors, who also is an enrolled agent, who will walk us through the key changes. I'll be jumping in with questions and examples to help you connect the dots to your own financial strategy. So let's start with the basics. Karen, what's the headline here for individual taxpayers?
All right. Well, thanks, Phil. For starters, the One Big Beautiful Bill Act, or OB3 is how we refer to it, is permanently extending the higher standard deduction and lower tax brackets introduced back in 2017. For 2025, that means that the standard deduction is now $15,750 for single filers and $31,500 for joint filers. This is a huge win for most taxpayers. Lower tax brackets mean lower marginal rates across income levels, and the expanded standard deduction really simplifies filing for many folks.
And for some of our clients, especially those over 65, we've been able to use this lower bracket environment combined with the new senior deduction to reduce tax withholding on IRA distributions or even Social Security benefits. It's a great time to revisit those withholding elections and potentially free up some monthly cash flow.
Great point, Phil. Let's go over those deductions. The deductions that we're going to talk about are available whether you itemize or even if you take the standard deduction. They're what are called above the line, which means they reduce your adjusted gross income, and that can help unlock or make you eligible for other credits and benefits. The first one we'll talk about today is called the tip income deduction. This allows an individual to deduct up to $25,000 of qualified tip income. Philip, you can't ask for your pay in tips. It has to be customarily and regularly received. There are some phase outs in this, so this is something that you'll need to work with your tax advisor to help understand how you'll be eligible.
Absolutely. And this may not apply directly to you, but if you have family or friends in hospitality or service industries, please share this with them. It's a rare opportunity to deduct tip income directly and could make a meaningful difference.
Absolutely. So there's another deduction that has to do with pay also, Philip. It's called the overtime pay deduction. This allows individuals to deduct the half portion of time and a half pay. This is a deduction up to $12,500 per individual and $25,000 on a joint return. Again, we have important phase outs that have to be monitored. So the important note on this is because these are new, overtime is not separately reported on the W-2. So in 2025, clients need to retain their detailed pay stubs, generally their last pay stub for the year, as their tax advisor is going to need this. The IRS is delaying mandatory reporting until 2026.
That's very helpful. Again, if this doesn't apply to you personally, it's worth passing along to anyone you know who works hourly or earns overtime. These deductions are temporary but powerful. Another new deduction this year is the auto loan interest deduction.
Yep, another big one. So up to $10,000 can be deducted annually for interest on a new U.S. assembled personal use vehicle. This doesn't apply to old loans. It has to be for purchases after January 1st, 2025. Guess what? We have some phase outs on this one too. What's going to happen for 2025 is clients will again need to track their own interest, usually via the year-end loan statements. Provide that to your tax advisor. Starting in 2026, lenders must issue a Form 1098-V. Important also is you will need to provide the VIN number, and that will be used to verify the U.S. assembly of that vehicle.
This is another lever that we can use to reduce AGI, especially in particular years where we're looking to do Roth conversions, especially for clients buying those new vehicles in the next few years. The last deduction we'll talk about today, which is also very powerful, is what's called the enhanced senior deduction.
Yeah, this is a good one. $6,000 per eligible taxpayer age 65 and older. This deduction can be claimed with both standard and itemized deductions. Phase outs again, Phil. Phase outs on this one. However, this deduction was introduced as a compromise to avoid taxing Social Security benefits directly. But let's clear up a common misconception. Social Security is still taxable. What's changed with this new deduction is it helps to reduce your overall taxable income, which in turn can reduce how much of your Social Security benefit is included in taxable income.
Exactly. The taxation of Social Security does depend on your other income. If you're drawing from IRAs, pensions, or investment accounts, that income can push more of your Social Security into the taxable column. This senior deduction gives us a tool to mitigate that, especially for clients that are below the phase-out range. It is gradual, but it's a great reason to revisit your income mix and distribution strategy.
Perfect. We've talked a lot about deductions, but there's some other things we need to talk about, Philip. We would need to mention is the changes around charitable giving and SALT taxes. Starting with charitable giving in 2026, standard filers will be able to revisit the deduction of up to $1,000 on a single taxpayer's return and $2,000 in cash charitable contributions. For those who itemize, there's a few new wrinkles that we have to be aware of in 26 also. First, there's going to be an AGI floor. So that means that a portion of your charitable deductions are not going to be deductible, the first 0.5%. There is an overall AGI limit also. Cash gifts to public charities are capped at 60% of AGI. Private foundations or non-cash assets may be limited to 30%. And finally, for taxpayers in those top tax brackets, 37%, the tax benefit of itemized deductions is capped at the 35% rate.
It'd be good to bring in a quick example of that. So before this bill, a $10,000 deduction for somebody in the 37% bracket reduced your taxes by $3,700. After this bill and moving forward, that same $10,000 charitable contribution now only reduces your tax by $3,500. The deduction amount doesn't change. You still deduct $10,000, but the value of the deduction is limited. For charitable givers, there is some benefit to front-loading your charitable contributions in 2025 to avoid the new limits coming next year. Please reach out if you have questions about this, because that's something that we can talk about in more detail.
Now, we can't finish this conversation about charitable giving without talking about QCDs. For clients age 70 and a half or older, qualified charitable distributions, or QCDs, from your IRA remains a powerful tool. You can transfer up to $108,000 in 2025, and that goes to $111,000 in 2026. These donations go directly to your charity, completely tax-free, and it counts towards your required minimum distribution.
We love QCDs for clients who do not need their full RMD. In fact, you can take a qualified charitable distribution, the QCD, well before your RMD age. It is a clean way to reduce taxable income and support the causes that you care about.
Perfect. So charitable giving lends itself into what's called the SALT tax deduction update. So as a reminder, SALT stands for state and local taxes. So we talk about SALT, we got to remind. The cap was raised to $40,000 through 2030. As a reminder, it was $10,000 under Tax Cut and Jobs Act. Now, this deduction only applies to itemized filers. If you take the standard deduction, this doesn't affect you. So this again is going to include state income taxes, property taxes to include real estate, and local taxes as well, like your personal property taxes. This is a huge win for clients in high tax states, but remember, if you're taking the standard deduction, SALT does not apply.
Correct. So if your SALT payments exceed the standard deduction, it may be worth running the numbers to see if itemizing does give you a better outcome.
Perfect. And one more thing, there is a lot of other smaller changes coming through. So here's a quick rundown of the other OB3 highlights. First is that new Trump savings account. So a new tax-deferred savings account for children under 18 can be established. There's a $1,000 seed deposit from the government for new children born 2025 through 2028. Parents and grandparents are eligible to contribute up to $5,000 per year, and employers can even gift up to $2,500 a year into these accounts. Employer contributions are not taxable to the employee, huge benefit. And this vehicle structure is still being finalized, so we expect news to come out probably mid-2026. Accounts may be advisor directed or government directed depending on that final framework. In addition to that, an important credit is the adoption credit. It's been around for a long time. Now, going forward, it's partially refundable, meaning you can actually get money back from this tax credit, up to $5,000 starting in 2025. The home energy credits are expiring this year. So if you need those windows installed or new exterior doors, the property must be installed, not just contracted, before the end of the year. And finally, Philip, this is a big one. The 529 has expanded quite a bit. So we've had in the past where it did cover K through 12. Now, however, homeschooling expenses can be covered under this expansion as well. The cap is $10,000 per student in 2025. That has not changed, but starting in 2026, it's rising to $20,000.
Correct, and that 529 expansion is huge for families, especially for those exploring alternative education paths. I want to circle back on a couple things we've talked about, which are Roth conversions. With these lower brackets, enhanced deductions, and temporary AGI reducers, we've got a rare window to fill up lower tax brackets intentionally. Roth conversions during these years can hedge against future tax rate increases, reduce future RMDs, and create a more tax-efficient legacy for heirs, especially if they'll be in higher tax brackets than you. So to wrap up, there's a couple key planning considerations that we want to touch on. A lot of these deductions, as Karen mentioned, are temporary. Most sunset after 2028. The phase-outs are aggressive, so high-income clients need projections. Above-the-line deductions can help qualify for other benefits, think ACA subsidies, education credits, or Roth eligibility. And Virginia hasn't finalized conformity, so state-level planning may differ from federal rules.
Absolutely. So here we have, on final thoughts, is that there's really a lot of planning that goes. Coordination really matters at this point. Whatever your individual tax situation looks like, whether you're still working, recently retired, managing a mix of income sources, we can help you fine-tune how these new provisions can apply to you. This is why we ask for your tax return every year. It's not just about taxes, it's making sure that your investments, your insurance, cash flow, and long-term wealth transfer strategies are all working in sync.
And just as important, we want to make sure your tax advisor is looped in. These strategies will only work best when your advisory team and your tax professional are all aligned. That's how we can avoid surprises and maximize benefits. We've already seen opportunities to adjust withholding, optimize Roth conversions, and reduce AGI to unlock other benefits. We expect more as the IRS releases further guidance. So if you're wondering how this applies to you, or if you want us to model out a few scenarios, please reach out. We're here to help you make the most of this window. Thank you again for joining us, and we'll see you next time. Thank you, Karen.
Thanks, Phil.